Right now, somewhere in the world, a trader is staring at an oil chart that hasn't moved yet. No explosion, no breaking news banner, no panic. And that's exactly why this moment is dangerous. Because markets never collapse when everyone is afraid. They collapse when almost no one is. If you own stocks, if you hold ETFs, if you have a retirement account, if you pay for gas, food, or rent, this story is already about you, even if you haven't realized it yet. Most people think geopolitical crises hurt markets when missiles fly. That's wrong. They hurt markets before that, when risk is mispriced, leverage is hidden, and confidence feels earned instead of borrowed. Iran sits exactly at that intersection. By the end of this documentary, you'll understand why Iran matters more to markets than most economic data, how professionals are quietly positioning right now, and what scenarios could move oil, inflation, and global equities in weeks, not years. This is not a prediction video. This is a risk mapping video. And this is how institutional investors actually think. Picture a trading floor just before volatility returns. Not chaos. Silence. Screens are green. Models are stable. Everyone agrees nothing dramatic is supposed to happen. That's when the system is most fragile. Because global markets today are not built on certainty. They're built on assumptions. And one of the biggest assumptions right now is that Iran will remain contained. News asks, will there be a war? Markets ask something colder. What is the probability of disruption? And is it underpriced? That single question moves trillions of dollars. Markets don't need wars to break. They need surprises. A delayed tanker, a disrupted shipping route, an insurance premium that suddenly doubles, small frictions amplified by leverage. You may feel like this is far away, but inflation doesn't care about distance. Supply chains don't respect borders, and capital never waits for clarity. Iran is not just another geopolitical headline. It sits at the crossroads of three systems the modern economy depends on: energy, shipping, and political signaling. When Iran moves, oil reacts. When oil reacts, inflation follows. When inflation moves, central banks lose control. That chain reaction is why every major hedge fund, bank, and sovereign wealth fund has an Iran scenario buried inside their models. Retail investors almost never see it. For decades, Iran has existed under pressure: economic, political, demographic. Sanctions didn't just restrict trade, they reshaped behavior. They pushed Iran into parallel financial systems. They normalized volatility for citizens. They trained the economy to survive instability, until instability stops being survivable. A young population, high inflation, limited opportunity, and an aging power structure. That combination doesn't explode slowly. It snaps. From a financial perspective, protests matter less for ideology and more for disruption risk. Unstable governments make faster decisions. Faster decisions carry higher error rates, and policy errors are what markets fear most. When unrest grows, models adjust. Export risk rises. Insurance costs increase. Shipping timelines extend. Transparency collapses. Each layer adds uncertainty, and uncertainty always demands compensation. That compensation shows up as higher prices. Oil is not just a commodity, it's a fear index. Prices don't rise only when supply is lost. They rise when traders imagine supply might be lost. That imagination is expensive. Higher oil feeds transportation costs. Transportation feeds consumer prices. Consumer prices feed wage pressure. Wage pressure feeds central bank paralysis. This is how a protest thousands of miles away touches your cost of living. Right now, markets are split. One side believes this will remain controlled, rhetoric without rupture. The other sees something different. A world where flashpoints overlap, where Ukraine, the Middle East, and Asia are not separate risks, but connected stressors. In that world, Iran is not noise. It's a catalyst. Catalysts don't need to explode. They just need to change expectations. And expectations are everything in markets. You can see the repositioning quietly. In options markets, in energy equities, in currency flows. No panic, just preparation. The United States isn't just a player here, it's a signal. Every statement is parsed, every pause is measured, every ambiguity is priced. Markets don't fear aggression, they fear miscalculation. The real risk isn't war tomorrow. It's something small tonight. A drone, a ship, a proxy incident. Low probability, high impact. And modern markets are terrible at pricing those. We've seen this pattern before. Complacency, shock, repricing. Different decades, same structure. Right now, global markets are priced for stability. Equities expect a soft landing. Credit expects calm. Commodities expect normalization. Iran does not price normalization. And that mismatch is where both danger and opportunity are born. In the next section, we'll break down exactly which assets are most exposed, which sectors quietly benefit from rising tension, and how institutional investors think in scenarios, not headlines. To understand where this goes next, we need to get very specific. Because geopolitics only becomes dangerous for markets when it touches mechanisms, not emotions. So let's talk about the mechanisms. At the center of this story is energy, not as a headline, but as infrastructure. Roughly a fifth of the world's seaborne oil trade passes through a narrow stretch of water that most people never think about until something goes wrong. It is one of the most strategically sensitive choke points on the planet. Not because it is always disrupted, but because it doesn't need to be. Markets price oil not on what is happening, but on what could plausibly happen next. And Iran has leverage precisely because it doesn't need to shut anything down completely. Partial disruption is enough. Delay is enough. Uncertainty is enough. A single insurance market adjustment can do more damage than a missile. When insurers raise premiums for tankers operating in perceived high-risk zones, shipping costs rise immediately. Those costs don't stay on balance sheets. They move downstream, into refineries, distributors, manufacturers, and eventually consumers. This is why oil shocks rarely announce themselves as oil shocks. They arrive disguised as inflation. Now zoom out. Global energy markets are already tight. Years of underinvestment, political pressure on fossil fuels, and capital discipline from producers have reduced spare capacity. That means the system has less shock absorption than it did a decade ago. In a loose system, disruption gets smoothed out. In a tight system, it spikes. That's the environment Iran is operating in right now, and markets know it. This is why the most sophisticated players are not betting on war or peace. They are betting on volatility. Volatility is where money is made when direction is unclear. You see this in derivatives markets first. Options volumes rise. Implied volatility creeps higher, not explosively, but persistently. It's a sign of professionals paying for protection while the broader market remains calm. That divergence matters, because when protection demand rises quietly, it usually means someone sees asymmetry. Limited downside if nothing happens, significant upside if something does. This is not fear. This is positioning. Now let's talk about equities. When geopolitical risk rises, markets don't sell everything. They rotate. Capital doesn't disappear. It moves. Historically, periods of rising geopolitical tension create a very specific pattern. Cash flow-heavy sectors outperform. Capital-intensive, growth-dependent sectors lag. Defensive names gain relative strength, not because they're exciting, but because they're predictable. Energy companies with pricing power benefit from higher realized prices. Defense contractors see increased order visibility. Infrastructure and logistics firms reprice risk into contracts. Meanwhile, companies dependent on global supply chains, low margins, and cheap financing feel pressure. This is not theory. It's pattern recognition. And here's the uncomfortable truth. Markets don't reward morality. They reward structure. Conflict reshapes structure. That's why you can see equity markets rising, even as headlines worsen. It's not denial, it's adaptation. But adaptation has limits. If energy prices push inflation expectations higher, central banks lose flexibility. Rate cuts get delayed. Financial conditions tighten, not by policy, but by reality. This is where Iran's situation intersects with monetary policy in a way that most casual observers miss. Central banks can talk tough about inflation. They can promise credibility, but they cannot print oil. They cannot reroute ships. They cannot neutralize risk premiums. They react, and markets react faster. This is why inflation-linked assets quietly regain attention during geopolitical stress, not because inflation explodes overnight, but because the probability distribution shifts. Investors don't need certainty, they need likelihood. Now consider currencies. In moments of global stress, capital looks for safety, but safety is relative. The US dollar often strengthens, not because America is perfect, but because it is liquid. In uncertain environments, liquidity becomes a feature, not a bug. But even that has nuance. A stronger dollar tightens global financial conditions. It pressures emerging markets. It raises the cost of dollar-denominated debt. It amplifies stress in places already fragile. Iran exists within that fragile layer, and fragility compounds. The more stress builds, the more reactive policy becomes. The more reactive policy becomes, the harder it is to signal stability. Markets pick up on that immediately. This is why language matters, not the headlines. but the phrasing. When officials use words like options, red lines, or consequences, markets don't hear resolve. They hear uncertainty, and uncertainty is volatility's oxygen. Now let's address something most people misunderstand about protests. Markets do not assume protests automatically lead to regime change. In fact, they usually assume the opposite. Systems tend to preserve themselves. What markets worry about is not collapse, but overreaction. Crackdowns that trigger sanctions, sanctions that disrupt trade, disruptions that trigger retaliation. Escalation ladders rarely start at the top. They start with misjudgment. This is why tail risk matters more than base cases. Most of the time, nothing happens. But when something does, it happens quickly. That's why professional investors think in scenarios. A base case where unrest fades and oil volatility compresses. A stress case where disruption is limited but persistent. A tail case where a single incident cascades into repricing across assets. You don't bet on the tail. You protect against it. That distinction separates speculation from strategy. And this brings us to sentiment. Right now, sentiment is complacent. Not euphoric, but comfortable. Markets believe they have time. Time is dangerous because geopolitical events don't operate on earnings calendars. They operate on human decisions, under pressure, with incomplete information. And when decisions are made under pressure, mistakes cluster. History shows this clearly. The largest market moves rarely come from expected outcomes. They come from misunderstood interactions. That's why watching correlation is critical. When assets that normally move independently start moving together, it's a sign stress is building beneath the surface. Energy up, defense stocks up, gold stabilizing, volatility refusing to collapse. These are not alarms. They are signals. Quiet ones, and smart money listens to signals, not noise. Now pause for a moment. If you're still watching this, it's because you already sense that something here matters beyond headlines. This channel exists for that reason. We don't chase news. We map risk. If you want to stay ahead of how this situation evolves and how it intersects with markets, policy, and capital flows, this is exactly what we track. Subscribe, and more importantly, tell us what you think. Do you believe markets are underpricing the risk here, or overreacting to noise? Drop your perspective in the comments. The best insights often come from the discussion. Now, let's move forward. Because the next phase of this story isn't about what Iran does. It's about how the rest of the world responds. Watch the shipping data. Watch insurance markets. Watch energy futures curves. And most importantly, watch what doesn't react until it suddenly does. In the next section, we'll break down the specific scenarios markets are watching right now, the probabilities professionals assign to them, and what indicators would signal a shift from noise to real repricing. This is where risk becomes actionable. Let's move from signals to scenarios. Because markets don't trade headlines, they trade probability-weighted futures. When professionals assess a situation like this, they don't ask what will happen. They ask what could happen, how likely each outcome is, and how violently markets would need to adjust if they're wrong. Right now, there are three dominant scenarios quietly shaping positioning. The first is the base case. In this scenario, Unrest in Iran continues but remains internally focused. Protests flare, subside, reappear. The state responds with force, information control, and selective concessions. External actors issue statements, impose limited measures, but avoid actions that materially disrupt trade or energy flows.